The balance sheet tells us at a particular point in time, what do I have, what do I owe, and what am I worth? What do I have, what do I owe, and what am I worth? It's going to include something we call the accounting equation. And this is one of these things that, yes, we do need to memorize. The accounting equation. It's in the gray box there on your handout. And the accounting equation says assets equal liabilities plus stockholders' equity. Assets equal liabilities plus stockholders' equity. Well, you might not know what all those words mean, but tell me this. Would you rather have an asset or a liability? An asset. So you do know something about them. Okay. That's one of those we need to commit to memory also. You might want to highlight that, turn down the corner of the page because we need to commit that one to memory for next week, next class. I give you a silly sentence here. I kind of doubt you're going to need it, but anyway, if that helps you. Let's talk about the items there. Assets. Assets are things of value that we own. Things of value that we own. Now let's think personally. Think about some of your own assets. Now, do not tell me about the intangible things like your charm and your charisma and your beauty and all that bit. But think of some of the tangible assets you may have. Tell me what some are. Car. Definitely. Good. What else? Land. You own some land. Very good. What else? Money. Money's a very good one. All right. Cash in the bank, in the savings account, in the checking account. Someone in my last class said in their IRA. I'm like, well, that's very responsible. I was glad to hear that. What was that? Stocks. Yes. If you own stocks and bonds in another company, definitely. Okay. What else? All right. Well, from a business's standpoint, here's some assets that businesses would commonly have. One is cash. In my cash, we can be referring to what's in their checking accounts also. Okay. Doesn't literally just have to mean dollar bills there. Accounts receivable. Accounts receivable is when I have done work for a customer and they have not paid me yet. I've done work for a customer, they owe me, they have not paid me yet. We say it is a receivable because I'm going to receive that amount at some point in the future. A notes receivable is similar. Somebody owes me some money. The only difference here is that this person has signed a promissory note. Now, here's a simple example of what a promissory note would look like. Okay, here we have Samuel Mason promising to pay Cook County Bank and Trust $1,000. He's making the payment on the promise on May 20th, and he's agreed to make the payment on August 18th. If we were a Cook County Bank and Trust, that would be a note receivable to us. It's a promissory note that is owed to us. Notes receivable and accounts receivable, again, very similar. In both cases, somebody owes me money. The difference being with a note receivable, they put that promise in writing. They sign a promissory note. Whereas with an accounts receivable, they did not sign a promissory note. In both cases, it's a receivable to me because I'm going to receive that money later on that. We can have inventory. Inventory are goods that we hold to resell. So if we are Walmart, inventory is all that stuff sitting out there on the shelf, in their trucks, in their warehouse. All of that is inventory. Prepaid items. Sometimes we pay for something in advance before we use it up. Okay. Supplies. I might buy pencils and paper and all that good stuff. All right. Supplies then are an asset to me. Sometimes I have to pay for other things in advance. I might have to pay my rent in advance. We would call that prepaid rent. I might have to pay my insurance premium in advance. We would call that prepaid insurance. So prepaid items are assets to me also. We can have other items. We can have land, building, furniture, equipment, vehicles, computers, all those good things. All right? Assets to me, things of value then that I own. Now, for right now, if you list cash first, I'm happy. That's all I'm looking for you to do right now is to list cash first. Some students start to get worried about the order, so I kind of mention it here in case you're one of those who wants to get it right. We're later on going to divide our assets up into two groups. And the first group, we're going to use the word crisp to put them in the right order. And that would be cash, receivables, inventory, supplies, and prepaids. Cash, receivable, inventory, supplies, and prepaids. Then we have items that last us a long time. Land, building, furniture, equipment, and so forth. For your purposes right now, you put cash first. I'm happy. Liabilities. Liabilities are our debts. They are the amount that we owe to someone else. Okay? Typically, it's an amount that I've got to pay at some point in the future. Without getting personal, tell me some of your own liabilities. Okay, student loans, amounts that you owe back for this education. Definitely, good. Anybody got an amount they owe for their car yet that they haven't paid off? All right. If you own a house, maybe you have a mortgage. Okay, that also would be a liability here. So liabilities are our debts, the amount that we owe to someone else. Typically, we're going to pay them in the future. Some examples. Accounts payable is when someone else has done something for me. I owe them money and I haven't paid them yet. Now, that might sound kind of familiar because just a minute ago I talked about accounts receivable. Accounts receivable are if I've done some work for you and you haven't paid me yet. To me, it is an accounts receivable, but to you, it is an accounts payable. So, a receivable to one party is a payable to the other party. We have to read the transaction carefully to see which side are we on. Are we the person who's done the work and not yet been paid? That's our receivable. Or has someone else done work for us and we haven't paid them yet? Then to me it is a payable. So we have to look carefully which side. If you see the phrase own account, in other words, if I make a purchase own account, that means I'm promising to pay for it later on. Creditors. Creditors are people we owe money to. Creditors are people that we owe money to. All right, notes payable, very similar to accounts payable. We owe somebody some money, but here we, thank you, signed a promissory note. Signed a promissory note, just like the one we looked up a minute ago. If we were Samuel Mason, who signed that promissory note a minute ago, to us that would be a note payable. To Cook County Bank and Trust, it is the notes receivable. Another one here that if I wrote this book, I would not mention it now, but I have to because I throw it into the homework. And that's something called unearned. Un means not, right? Okay. So with an unearned revenue, this is a case where I have gotten paid in advance and I haven't done the work yet. Paid in advance, haven't done the work yet. Does that happen to you? It doesn't happen in my life. Here I have to work for a month and get paid and then work and get paid and so forth. Most people work and get paid later on. There's a great example of people who get paid in advance, which is right over that way. If I could throw a rock a really long way, I could hit it. Anybody got any ideas what I'm talking about? Airport, exactly. Anybody ever flown before? If you flew, did you go on the flight and then when you got off and landed, hand them money for that flight? No, you had to buy that ticket in advance. So airlines get paid in advance before they perform the service. Okay? It's very common in some businesses. Airlines are a great example. A magazine publisher gets paid in advance for a one-year subscription before they start doing any work and sending any of those issues in. In some businesses, it's very common. Again, if I wrote this book, I wouldn't include this now, but your book does. And they give you one example, and I'll go and tell you which one that is. They're dealing with, kind of like down there at Carolina Stadium, you know, all those people who rent their parking lots out, where they get paid. And the example here is that the company is getting paid in advance and people are going to use their parking lot like in the next couple months. So when they get paid in advance, have they done the work? Have they earned the revenue? No. To them, that would be an unearned then when they get paid in advance. I'm really not going to talk about that anymore until we hit chapter 3, then we'll talk about it a lot. But your book does throw it into a homework problem, so I want you to be aware of that. There are other types of payables I could have, of liabilities. I could have wages payable. That's the amount that I owe to my employees if they've worked for me and I have not paid them yet. Taxes payable would be an amount that I owe to the government. Mortgage payable would be an amount that I owe to my mortgage company then. Do you see a key word in almost all of those? Payable. Okay, so you see that word payable, you need to think liability. If you see that word receivable, you need to be thinking asset. Okay. Stockholders' equity is the net worth of the business. Okay, the net worth of the business. Theoretically, if we were to go out of business, sell all of our assets, pay off all of our debts, what's left is what the owners would walk away with, and that would be my stockholders' equity. It never works out that way, okay, but theoretically if it did. Okay. What if I told you this? I have $100 cash in my pocket. That'd be a lie. I never had more than like $3 cash. Don't do cash. Anyway, I have $100 cash in my pocket. That's all I have in the world. I owe my neighbor $20 because I borrowed money from him last week. It's all my debt in the world. So I got $100 cash in my pocket. I owe my neighbor $20. What's my net worth? 80. You just use the accounting equation. You might not have realized it here. Accounting equation says assets equal liabilities plus stockholders' equity. Assets, $100, cash in my pocket. Liabilities, $20 I owe my neighbor. 100 equals 20 plus equity. My equity must be $80. There's some property in math, but it says you can subtract the same thing from both sides of the equation, and that's okay. Well, if we apply that property, we could subtract the liabilities from both sides, and what we could see is that assets minus liabilities equals my stockholders' equity. That's really how you went about solving my problem just then, didn't you? You said $100 assets minus $20 liability. Says my equity then must be $80. So, theoretically, if we went out of business, sold all the assets, paid off all the bills, that's how much the owners would walk away with. We're going to be using this equation over and over. When we talk about stockholders' equity, you know I gave you a long list of assets a minute ago. Gave you a pretty long list of liabilities. There are only two things we're going to pick up that we're going to call stockholders' equity. Number one is called capital stock. Corporations can issue shares of stock. People buy that stock. All right, the amounts we receive from issuing that stock we're going to call capital stock. As we have more shares of stock outstanding, my capital stock will then go up. The other item is called retained earnings. Retained earnings means exactly what it says. Retain means what? To keep. So retained earnings are earnings that we have kept. We don't always keep all of our earnings. Sometimes we pay them out to our stockholders in the form of a dividend. So retained earnings are earnings that we have kept. Those are the two items we're going to have that will show on our balance sheet under stockholders' equity then. Here, I just pulled one here just so you can see how it looks in the real world. Here's Walmart's. Notice under assets, they have some of the things we just talked about. Cash, receivables, inventories, prepaid items, land, building, fixtures, equipment. Okay. They got a few other things we didn't mention, but you see the main idea there. Under liabilities, notice they have accounts payable. They got some taxes payable. Long-term debt would be like the long-term promissory note and so forth. Under equity, now they don't actually say capital stock. Do you see they say preferred stock and common stock? Do you see that? Okay, we're going to later on differentiate ours between the preferred and common, but right now we're just going to keep it simple and call it capital stock. And then do you see they also then have their retained earnings as well? So just to show you some of these items that we talk about in class, you can look out here for any particular company and find them out on their website also with their financial statements. Okay, we're going to do a balance sheet. What page of the handout are we on? 16. Everybody with me on page 16? Okay. Here we have some items we're going to report on our balance sheet. What I want you to do first is I want you to look at each of those 7 items there. If it's an asset, would you write the letter A beside it? If it's a liability, would you write the letter L beside it? And if it's part of stockholders' equity, would you write the letter S beside it, please? A for asset, L for liability, S for stockholders' equity. How about accounts payable? What type is it? Liability. Good. How about accounts receivable? Asset. Cash. Asset. Good. Land. Asset. Good. Notes payable. Liability. Capital stock? Part of stockholders' equity. Good. And then retained earnings? Part of stockholders' equity also. Good. All right. We're now going to prepare our balance sheet. Okay? First line of the heading is always the company name. Second line is the name of the statement. The third line of the heading for the balance sheet is different from what it was for the income statement. You'll recall for the income statement, it was what? For the month ended April 30th, I believe. For the balance sheet, it is simply that very last day, April 30th. This is not how much we had all month long. This is at the close of business on April 30th. What did I have? What do I owe? What am I worth? So, simply April 30th. What's the formula then for our balance sheet? What do we start off with on the balance sheet? Assets. All right. Let's write the word assets. Assets. What sort of assets did we have in our example here? Accounts receivable. What else? Cash and land. Which one did I tell you we're going to list first? Cash. All right. So we're going to list cash, accounts receivable, and land. Now, I really don't care which column you put these numbers in, honestly. I have them in the far right column. If you would rather put them in the middle column, it's okay with me. Just to review, is there anything magic about the columns? No. When we're adding numbers together, they just have to be one beneath the other with nothing in the middle. If we're subtracting one number from the other, it has to be one beneath the other, nothing in the middle. That's all we're trying to accomplish. Simply, they are just a way of structuring it so that when you add numbers together, they're one beneath the other, and when you're subtracting one from another, they're one beneath the other. That's all. All right, so we have 3 assets that total up to $5,500. Let's double underline that and give it a dollar sign because that's our final figure. All right, so that's my assets. What comes after my assets? Liabilities and stockholders' equity, right? Okay, so I'm going to put the liabilities and my equity up there next. And then we're going to list those. We'll put the liabilities first. What sort of liabilities do we have?
Accounts payable and notes payable.
Good. We had accounts payable and we had notes payable. If we add those together, we see that my total liabilities then are $2,000. Again, I have those in the far right column. If you would rather put the 300 and 1,700 in the one beside it, that's okay with me. Put the 2,000 in the far right for sure. All right. Assets equal liabilities plus stockholders' equity. Well, we've listed the liabilities. We got a total. Next, we need to list the stockholders' equity. All right. What 2 items do we have for stockholders' equity? Capital stock and retained earnings. Now, for these 2, I do need you to put them in the inside column, and then we'll add them together. 1,000 capital stock, 2,500 retained earnings. If you add those together, you're going to see my stockholders' equity is $3,500. Now, why did I put these 2 numbers over here in this column? I need to take that total and do what with it? Add it to the 2,000, right? And if I stuck these right here in the middle, would I be able to tell exactly what I'm doing? Not really. So I needed to have this directly beneath here. In order for that to happen, I had to move these over here to the left a little bit. That's all. Okay? Just making it a little easier on the eyes. So my liabilities were $2,000. My stockholders' equity is $3,500. If I add those together, my total liabilities and stockholders' equity together is $5,500, which, like magic, is just the same as the amount of my total assets. Again, double underline that number, give it a dollar sign. Yes, sir. Double underline the $5,500 at both places, on the asset side and then on the liabilities and stockholders' equity side also. So we already know the formula for the income statement. We need to, by next class, now know the formula for the balance sheet. If you ever miss class, or maybe you didn't copy something down all the way in class, I do have these slides out there in D2L. Don't know if anybody noticed that, but it's out there right beneath the handout. It's actually a PDF version of these slides, and you can pull it up and just, if you aren't sure you copied something down right or such. And all right, let me talk about a couple of areas which get confusing for students. Now, these might not have crossed your mind yet, but perhaps they have, and I want to make sure that you understand these if we can address them now. One is the difference between an asset and an expense. For example, what if I told you I went to Staples and I filled up my buggy with pencils and paper and toner and all those consumable supplies? We would have to decide, do I have supplies, the asset, or do I have supplies, expense, an expense? Well, to know the difference between the two, here's the rule. When we buy something, it is an asset to us. It will become an expense to us when we use it up. So when we buy it, it is an asset. It becomes an expense to us when we use it up. Another area that confuses some students is the difference between assets and revenues. Now, I asked you a minute ago, would you rather have an asset or a liability? And everybody said we'd rather have an asset. Even if we don't know what it means, we know we like it. You told me last class you'd rather have a revenue than an expense. Even if we didn't really know what it means, we know that we like that also. Assets and revenues, we like them both. However, they are completely different. Okay? Revenues are what we earn by doing something. Performing a service, selling a product, that's how I earn revenue. Okay? Revenues go on the income statement. They are intangible. You cannot touch a revenue. Typically, if I earn revenue, the byproduct or the result is that I receive an asset. If I cut your grass, I've earned revenue. Typically, the byproduct or the result is that I receive what? Cash. Normally, I get paid in cash for that, right? Assets are tangible. We can touch them. They go on the balance sheet. I can receive an asset without earning revenue. What if I went to the bank and borrowed $1 million? I now have $1 million cash. Have I earned revenue? No. Why not? To earn revenue, I have to do something, perform a service. So just because cash comes in does not mean necessarily that I have earned revenue. Similarly, we didn't like liabilities, remember? And we didn't like expenses either. However, those are entirely different. Expenses are the cost of doing business. If you're going to earn revenue, you're going to have to incur some expense. We had mentioned last class, for example, if we were a law office, we would have some expenses for the salaries to my paralegal, for my rent, for my utilities, for my insurance, and so forth. An expense will become a liability if we don't pay it. If we don't pay it. So if I use up electricity, okay, I've got an expense. It only becomes a liability or debt to me if I don't pay it. If I don't pay it, then it becomes a payable. I can incur a liability without incurring an expense. Again, back to my example. I go to the bank and I borrow $1 million. Do I have a liability? A really big liability. Now, we're going to forget about the word called interest. We're going to live in a perfect world. There is no interest right now. I borrow money. No interest. All right. I have a debt. Do I have an expense? No. No. Now, if I had interest, that would complicate matters. But pretending no interest, just because I have a debt doesn't mean that I have an expense. So expenses go on the income statement. They are the cost of doing business. An expense that is not paid becomes a liability, and it goes on the balance sheet then. Let's make sure we understand the difference between accounts receivable and accounts payable. It is the same transaction from the opposite party's perspective. What if I cut your grass and you promise to pay me later? I cut your grass, you promise to pay me later. What is it to me? A receivable. I'm going to receive that money later on. What is it to you? A payable. You got to pay it later on. So a receivable to one party is a payable to the other party in that transaction. Receivable to one party is a payable to the other. If you see the phrase own account, you can know that we're dealing with a credit transaction. If I perform a service on account, that means I did work for a customer, they didn't pay me, they promised to pay me later on. They owe me now. If I receive payment from a customer on account, that means I had somebody who owed me money as an accounts receivable. They're making payment towards the amount that they now owe me. If I purchase goods or services on account, that means I bought something and I promised to pay for it later on. If I make a payment on account, that means that I have an outstanding debt that I owe to someone and I make a payment towards that amount that I owe them.